Fascinating about our business is that all capital is not created equal. And I think it's what keeps the business always so vibrant, as different sources of capital have different risk parameters and different approaches. And our next speaker, our keynote speaker, is Bob Morse, who's going to speak about the future also of real estate. Bob is the chairman of Bridge Investment Group. That's a holding company that's publicly traded, but within that there are numerous individual funds with different strategies. Bob also spent a considerable amount of his time in Asia, so he's really the perfect person to discuss where we're going in the future right now in our post-pandemic environment. Join me in welcoming Bob Morse. Thank you, Bob.
Thank you all, and thanks for your time and attention this morning. The conference organizers were gracious last night. They among other things, hosted a dinner at Morris for some of us. And Kevin required that we had a Morris cup, which was green. I think it was the jumbo-sized version of a Long Island iced tea, because it had a number of different forms of alcohol in it. And so I think all the speakers ended up sharing DNA as we passed the cup around. Some of the things that I'm going to say will resemble very closely some of Paula's comments, and I think we certainly share the view that real estate is a very attractive asset class at this point for both secular and cyclical reasons. So what I wanted to do today was talk a little bit about the cyclical opportunity. The title of my presentation is Emerging from a Long Winter. It's been a tough couple of years in real estate as the impact of rate increases and other factors had negatively influenced real estate prices from the peak in 2021 through, in our view, the first or second quarter of this year. We've started to lean in pretty significantly as an investor in 2024, and we think that there are some terrific values. All real estate is not created equal, but within the overall ecosystem of real estate, we think that there's some terrific opportunity as we see it. You know, maybe under the theory of trying to summarize what I'm going to say and then going into some detail, we see the current environment as in many respects echoing what the environment was in the aftermath of the global financial crisis, which really ended, in the 2010-2011 time period. At the time, real estate asset prices were meaningfully impacted. The delta, the difference between the price and value of existing assets and the cost of new construction was pretty significant. There was maybe a 40% discount on average, some more, some less, of buying existing assets versus developing new assets. And then over the course of the ensuing 10 years until the last peak of the real estate market in 2021, that discount sort of asymptotically diminished, such that by 2021, the value of existing assets and the cost of new development were right on top of each other in a lot of respects. And that provided a lot of the impetus for some of what we think is temporary oversupply in markets that you see today. But since 2021, you've seen a depreciation in real estate values. I have a slide that shows what that depreciation has been by sector for U.S. real estate assets, and the cost of new construction has continued to grow. So that discount for existing assets has reappeared, and that discount, at least from the billions of dollars of transactions that Bridge Investment Group has executed this year, we think is in the 30 to 40% range. So it provides what we think is an opportunity, different but similar opportunity that's comparable to what we saw in the aftermath of the global financial crisis, meaning that there's significant value in investing in real estate today. although we are a specialized real estate investor and almost everything that we do is focused on U.S. real estate, focused on the value-added sectors of selected areas in U.S. real estate today. We're acutely conscious of the fact that investors, whether they be institutional investors or retail investors, have a lot of alternatives in terms of in terms of where they invest. It's been very hard to outperform the public markets over the course of the last few years. 20% plus returns, and no illiquidity premium. We think that will change as we look forward. We think that real estate as an asset class will rise in appeal, will rise in prominence, and we're firm believers that the time to invest, the time to lean in, is before there's a general consensus that things have changed, and that's really today's time, we think, in a lot of respects. We as a company have at least an informal policy that we're gonna that when we speak publicly, we provide an overview of Bridge. I'm going to skip through this. I think everybody has the slides and they can look at. Just as I skip through that, would point out that Bridge is about a $50 billion in AUM asset manager. We offer specialized funds that focus on selected sectors within U.S. real estate. Almost all value-add opportunities. We're forward integrated. We manage virtually everything that we either acquire or develop, and we think that that's an excellent way to create alpha at the asset level to drive returns. We're not all things to all people. We focus primarily on residential rental, broadly defined in the U.S., and are aware of the very significant housing shortage that exists in the U.S. We focus on logistics and industrial. We have a meaningful credit suite of funds as well, using multifamily as the underlying collateral, and some other ancillary businesses in solar infrastructure and other areas as well. There are a lot of ways to play real estate, if you will, and our areas of focus really are designed to not only take care of the cyclical opportunity that I referred to earlier, but also take advantage of what we think are some very durable secular tailwinds, particularly behind credit and residential rental and logistics and industrial. And we think that those durable tailwinds have a 10-year plus life as we look at the ongoing development of the U.S. as a country and the economy. We had provided some macro insights, if you will, and I'm conscious of not wanting to duplicate what you just heard, but just to touch on a couple of things. We think that the U.S. is a great place in which to invest. While there's strong projected growth across the G7 and other countries, the U.S. stands very tall in terms of offering an environment for positive investments, both looking backwards and looking forward. And it's in many respects sort of remarkable how such a large developed economy can continue to innovate, to lead, and to increase in productivity and elsewhere. We as a firm believe that inflation is under control, that it's approaching central bank targets. There's a lot of impacts to inflation. Obviously, the cost of real estate is one influencer of inflation, and that's come down. Cost of energy has come down and is expected to continue to decline. A lot of folks believe, including a great Yale supporter, Daniel Yergin, that we've reached peak energy usage, and the continued proliferation of renewable energy is just going to exacerbate that trend. And so, notwithstanding what is a significant fiscal deficit, we feel that inflation, which was an issue, presumably will not be as much of an issue going forward. There always is uncertainty as it relates to how one assesses the outlook going forward for the economy. There are a lot of positive factors that we feel outweigh the risks to the economic outlook in the U.S. The consumer, although meaningfully indebted, remains very strong, remains spending. Wage growth is high. Importantly, within the aggregate data on wage growth, the lower earning cohort of the U.S. population is doing better than ever. Not as well, perhaps, as they should, but lower tier wages have grown as a percentage and on an absolute basis quite strongly, and that's provided a continued push to consumer spending as well. I mentioned falling inflation, and I mentioned wage growth. We continue to see a positive environment and full employment. So we love the economic backdrop against which we're investing in the U.S. It appears to us that the Fed has improbably stuck a soft landing for the economy, and while we believe that there will be some incremental rate reductions as we go forward, certainly the beginning of 2024 expectation that we'll see 6 or 8 rate cuts we think has diminished, and that market expectations look for what is now a positively sloping yield curve, a modest reduction in short-term rates, and probably longer-term rates that are close to the levels that we see today, maybe a bit of a diminishment from here. But we're not going back to an era of zero nominal rates and negative real rates for interest rates in the U.S. And we think that to succeed, one has to be able to navigate through a more normalized rate environment than has been the case in the past. This slide details the past and current expectations for rate increases, and importantly, the yield curve has normalized. There's not much of an upward sloping between the 2 and 10-year treasuries, but the inversion that we've seen in the past has gone away. What's really important from a real estate perspective is short-term rates have come down pretty significantly from where they were peaking, and as a lot of real estate is financed on a floating rate basis, that is an immediate help to real estate values in some respects. I think as you see different publicly traded real estate managers report results for the fourth quarter, you will see those short-term rate reductions reflected in the asset values that they report. Generally speaking, public companies report 1 quarter in arrears. So the third quarter reports will show second quarter values, fourth quarter year-end reports show third quarter values. But those short-term rate reductions should translate into value appreciation in existing portfolios. What I'd really like to talk about, though, on this slide is why, when investing in real estate, you have to differentiate in terms of where you invest. There's been a significant difference in value diminution between sectors in the U.S. As you can see, the office sector has declined massively on the left end of the scale, and certain specialty areas, I'll focus on single family for rent as an example, have shown very little, if any, decline in value between 2021 and the current period of time. We estimate of approximately $3 trillion office market. Office, remember, was sort of the centerpiece of many core and core plus strategies in the U.S. We feel that the office market has lost as much as $800 or $900 billion of value. You can't pick up a paper any day without reading about some very prominent default of an office building in San Francisco, in Los Angeles, in New York, elsewhere. There are some exceptions to that rule, and generally speaking, the equity owner has lost all of her or his money, and the debt trades at a 50 or 70% of par value in that repricing. There's a lot of anticipated obsolescence in the office market, which is going to further exacerbate things. We think we've just seen the tip of the iceberg as it relates to the office market, because there's been a lot of so-called extend and pretend actions by banks, and we think that as maturities start to manifest more fully in 2025 and 2026, we're going to see a meaningfully greater amount of distress on the office side. As an example, before getting into some of the other sectors, I did want to just emphasize the point that Paula made earlier, that it's hard today to actually discern in many cases where value is, because transaction volumes have remained pretty diminished at this point. In the markets in which we participate, most of our activity is transacted with motivated sellers who, whether it be because of a loan maturing, whether it be because of cash flow issues, and a flawed and imperfect capital structure, they have to monetize assets, and they know that they need to monetize, that they are monetizing assets in a difficult, buyer-friendly environment. What's really interesting is that at the end of last year, when the general market expectation was that we would see 6 or 8 rate cuts by the Fed, all those same sellers were holding off. They're saying, I don't want to look dumb. I'm going to wait until a couple of rate cuts are under our belt, and then I will put my asset on the market. Since that expectation has changed, that's created a bit of a groundswell of activity by investors, by owners who say we're probably in as good of an environment as we'll see for a while, so now's the time to sell. What also is really interesting, and I'll use multifamily as a proxy here in some respects, is there's a big difference between optimized assets and value add assets. Over the course of this year, we've sold about 2,000 units of multifamily, and we've acquired about 5,000 units of multifamily. The 2,000 units that we sold at an average cap rate that was somewhere in the high 4s or so, and the 5,000 units that we bought at an average cap rate that's in the mid 5s. So there's a 50 to 75 basis point delta between assets that are easy on, easy off, where somebody can come in, generational ownership, a family office or somebody might like to come in and buy an asset and hold it generationally, and an asset that you have to roll up your sleeves and do some work at the asset level for, and we'd love to take advantage of some of that value. I'm gonna before getting into individual opportunities, I'm gonna spend a little time on the retail market as well. We of course, real estate values and activity depends on supply and demand. In our view, and I think this is a view that's widely shared, there's an increasingly important component of retail participation in the private real estate markets. There's a proliferation of mostly REIT structured vehicles that allow so-called accredited investors, the mass affluent, to participate in what heretofore have been institutional retail opportunities. There's an enormous amount of appetite there. The retail market is underpenetrated, certainly relative to the institutional market, meaningfully underpenetrated. The earlier activities, mostly with wealth management platforms like Morgan Stanley and JP Morgan and UBS and elsewhere, has been pretty dramatically expanded through the creation of accredited investor compliant vehicles, allowing for broader participation in the real estate markets. And there's been a number of very successful products that have been launched by a number of real estate managers, including Bridge, to offer compelling product for the retail investor. We think that the retail opportunity just in the next 5 years is in the $5 to $10 trillion of potential incremental demand range, and we think that alone is going to be a factor that helps to support real estate activity going forward, something that we're very excited about. In addition to that, going back a little bit to an earlier slide, the preeminence of the U.S. in our view, in our experience, is driving a lot of non-U.S. capital to the U.S. capital markets, and particularly to the U.S. real estate markets. The number of Middle Eastern sovereign wealth funds, Korean insurance companies, Japanese institutions, European pension plans, et cetera, that are investing in the U.S. continues to be strong and continues to grow in a lot of respects. So we see in that context a meaningful amount of capital coming into the U.S. that those capital flows we think will help to drive a recovery in prices as we go forward as well. Where are we focused as we think about where value is, and recognizing that nobody can be all things to all people? We feel that there are selected sectors that offer significant opportunity at this point. The first is in the real estate credit markets. As Paula did mention, the composition of lenders has changed pretty significantly. Many, not all, but many local and regional banks, which were pretty tough competition for a number of years, are out of the market at this point. The overall bank market has, as it relates to real estate, has diminished on the development side, as gentlemen asked the question before, and on the lending side as well. Much of that supply has been supplanted by private debt funds, like the private debt fund that Bridge Investment Group has. And those private debt funds, we think, are pretty well positioned to take some of that capacity in a disciplined way. There's an enormous amount of, as shown on the right-hand side of this page, there's an enormous amount of maturities that are coming due. And when you think about the opportunity today, a new loan that is created today is created against, by definition, a resilient asset, one that has been repriced, with a new capital structure that's more consistent with what the parameters are today, and so should show some pretty significant returns. Prior to 2021, when we were lending, although we were always disciplined, we were often forced to lend, between 70 and 75% of the capital structure as a senior loan. That loan to value has diminished in today's market. It's probably closer to 65% than 75%. Spreads have remained really attractive, and I want to talk a little bit about the interplay between real estate loan spreads and the overall health of the capital markets in a second. But spreads have remained attractive, and when as a lender we suggest in quotes that a borrower agree to selected covenants that we want to impose on the borrower. Whereas in the past the answer was, "We'll think about it." The answer today is, "Thank you for considering making a loan to us, and we'd be happy to observe the covenants that you suggest." So there's more more protection, lower loan to value, resilient asset at a repriced level, and we think all of that translates into some really, really attractive opportunities. Most of our lending, as an example, is against the multifamily sector, and multifamily assets are pretty resilient. What we do is we make individual loans. We aggregate those loans on a warehouse line, and then we will securitize those loans in a commercial real estate backed CLO, and that allows match funding of the underlying loans. It allows us to take advantage of the strength of the capital markets. How that translates is our investment vehicle. Our fund ends up owning the CLO equity. So when you think about the capital stack, there's some AAA, AA, BBB tranches of the CLO. Then there's the CLO equity, which is what our fund holds. And then finally, there's usually 35% of borrower equity underneath the CLO equity. Given the strength of the capital markets, that CLO equity today, which the fund holds, is priced at is valued at about SOFR plus 900 basis points or so, and so that mid-teens return, we think, creates a great deal of opportunity today when you can lend against resilient collateral at a 13 or 14% return. We think that compares very favorably, really across almost all asset classes as it relates to fixed income. The second area that we focus on and we think has durable secular tailwinds behind them is logistics and industrial. And we say that because we recognize that the U.S. is short on infrastructure, broadly defined. There's a continued growth in e-commerce. There's a continued growth in reshoring and onshoring and manufacturing. Look at the CHIPS Act as one example of that, and all the chatter about onshore manufacturing and tariffs, candidly coming from both sides of the aisle in the current presidential election. And so we think that continuing to invest in the logistics and industrial infrastructure of the U.S. is a safe and durable bet that can be made. If you recall back to the slide that looked at the value diminution of different classes of real estate, logistics was really sort of in the middle there. But what in our view really distinguishes logistics is how individually owned so many of the last mile logistics, industrial outdoor storage, last mile distribution, and other assets are. We probably transact somewhere between 70 and 80% of our activity in logistics on a one-off basis. Often those transactions are done with owners who've owned an asset for 20 years or 30 years. Often, in our view, the existing rents in those assets are 50% below market for good reasons and bad, and so it just offers enormous opportunity we see when you can invest locally and be aware of what the local nuances are of different markets for logistics. We certainly believe that local knowledge is fundamentally important across everything we do, but nowhere more so than in the logistics market, where you can uncover hidden gems in the market and really make them sing through incremental capital investment and positioning in the marketplace. We think that is a $10 to $15 billion opportunity for our company alone over the next 5 to 10 years, and think that there's opportunity for many in that sector. We are equally excited about the residential rental market, broadly defined, and different parts of that market for different reasons. We love the multifamily market, the value-add multifamily market. We are aware of short-term supply increases that are coming to market, but we're also aware of the fact that it's very, very difficult today to cost-effectively initiate new development projects. And so we think that short-term bulge will work its way through the system pretty quickly, and we will quickly return to an era where absorption is much greater than new supply, and we'll see continued gains in occupancy. We'll see continued gains in NOI at the asset level. We think that within multifamily, broadly defined, the middle market, Class B multifamily sector is the most attractive of every new development that has taken place since the year 2000. Something like 85% has been Class A. There's almost no new Class B development that's taking place outside of selected new developments in so-called tax-advantaged opportunity zones. And yet the broad middle market of workers in the U.S., of firefighters and policewomen and men and nurses and things, that's the market that is so underserved and such an opportunity to serve in a positive way that extends further down into the workforce and affordable housing arena. We own about 25,000 units of workforce and affordable housing, and that's been a fantastic opportunity for us. It's been great for our communities. We work hard to energize and empower those communities with social and community programming, and we work hard to deliver profitable investments to our investors, and being on the ground 24/7 is the way to do that. You can't support affordable housing without providing returns to investors, and we think we've figured out how to do that in a positive way. We're equally excited about seniors housing. The U.S. in particular, sadly a great manifestation of that, is growing older. And managed care is a critically important part of an aging population in the U.S. For what it's worth, just to give a sense of the scale of opportunity there, we're closing a transaction shortly where, sadly, somebody developed a terrific seniors housing facility, costs $100. We're buying it 85% leased at $75. So all the equity is gone. We're working closely with the lender to make sure that they're treated okay, but just okay. And the new basis at which we're entering into that particular asset is just so attractive. And we think that when we look at the development pipeline for new seniors housing assets, it's almost non-existent in a lot of respects. You have to be careful, what market, where, when you invest, but we see great opportunity there. We see great opportunity in the single-family for rent market. The institutional ownership of single-family homes is about 2% at this point. There's a lot of institutional growth that we think will take place. Again, because real estate is a separate and distinct asset class, we think that there's value that either can be gained or lost by operating assets. We are very proud of the fact that our residents, the folks who rent our single-family homes, when they assess whether they want to own a home or buy a home, They love the fact that when their hot water heater breaks, they call Bridge. They don't have to stay home from work. They don't have to wait for a plumber to come. The cost differential between owning and renting today is at an historic high, and we see very strong continued gains in the single family for rent market as we look forward as well. I've skipped quickly across a number of these slides, and I wanted to leave time for questions, which I will invite shortly. But just in terms of the concept of recognizing that, in our view, 2024 is a watershed year, and one in which it's appropriate to lean into these investment themes. We think that private real estate credit, logistics and industrial, and residential rental broadly defined represent the areas of greatest opportunity in the U.S. at this point. I did want to make one final observation about chasing new initiatives and things, and undoubtedly, for example, with respect to the growing power and data demands of artificial intelligence, there's so much chatter in the markets today about investing in data centers, and some people will make a great deal of money investing in data centers. To us, there's a little bit of an echo of what happened in life sciences a few years ago, where everybody wanted to turn every office building into a life sciences center. Many did, and now life sciences is struggling. And while certain opportunities manifest themselves and grow into permanent components of what should be a diversified real estate portfolio going forward, I think one has to the extent that it's possible, make sure you understand very well what the secular, durable, either headwinds or tailwinds to a particular sector are while investing. And we love where we're focused. We think that those are good areas of focus, not the only areas of focus, but areas that should show some meaningful investment returns going forward. So thank you very much for your time and attention. I'd love if I have time to take some questions.
Thank you. Referring back to your last
Hard
point.
with the lights, it's like an interrogation.
Yes, about the data centers. I'm working on a couple of those projects right now, and I'm curious. You mentioned, the potentially mixed horizon for those sorts of things because it looks a bit like a boom, which I think it is. It's a gold rush. What are those headwinds that you see, and what makes you feel cautious about it? What makes you feel excited about it? And you mentioned one thing about, of course, we all know power is a huge piece of any data center project. You've got to have it. And the question is, that is electrical power. What about the power? You said something about having reached peak power, I think, at one point, or power demand, energy demand. And it seems like with this data center boom, we're looking at a sort of almost order of magnitude growth in our demand for power. So throw that out there for you to
Thanks for the question. If I didn't say, I meant to say peak oil demand, not power demand. I agree with you that power needs will continue. The different sources of power are pretty prolific at this point. I know a lot of folks are talking about modular nuclear power. There's some really exciting developments about nuclear fusion as well as nuclear fission on a modular basis that are taking place. I think that a lot of people will do very well investing in data centers. The factors that, in our view, will influence how well you do in data centers depends on where they're located, what market they're oriented towards, whether they're technologically appropriate relative to what the customer base is in that area, and how well and efficiently they operate. And a lot of people will succeed pretty significantly in that, particularly if you can lock in long-term contracts with credit-worthy users who employ that. I think in today's market, there's definitely negotiating power on the part of the data center owners. What worries us a little bit is how that power dynamic shifts, with the Amazons and Microsofts and Googles of the world, when data centers get a little bit more commoditized, because those are big users and they haven't gotten to their size and scale by being easy negotiators in a lot of respects. But for the near term, we think that there's pretty significant opportunity in data centers if you have the right capabilities to locate, design, build, and operate them. And certainly wouldn't ever want to diminish in any way the opportunity in that respect longer term. We believe that market will normalize and sort of come back to earth a little bit in terms of what the returns would be.
Bob, just curious about your thoughts around the opportunity zone space and the extension of the legislation, knowing it's coming due relatively shortly and knowing that Bridge has been a major player in that sector.
Thanks for the question. It's something that we focus on quite a bit. We had a what was supposed to be a 15-minute call with Senator Cory Booker a bit ago and turned into an hour call. He was one of the two bipartisan sponsors of opportunity legislation. In our view, and I think it's a view that's shared by the housing and urban development community in Washington, opportunity zones have been a really effective part of tax policy of creating real estate development in heretofore developed areas of the country. There are 7,800, either 7,400 or 7,800 opportunity zones that have been designated across the country, and the tax incentives have spurred a lot of development. It's been good for the communities. It's been good for the investors, and I think it's been effective tax policy for the government. There's a lot of as we understand it, there's a lot of discussion in Washington now, obviously pending who's sitting in the White House going forward, of refreshing and extending that legislation. And we think with if that legislation is extended, we'll continue to see opportunities related to opportunity zone development. We have 74 developments that we either have completed or are in the process of completing at this point. Every one of them has a meaningful multifamily component. Almost every one of them has a meaningful affordable housing component. There's not a city in the country that doesn't lack affordable housing, and so it's very valued. And the tax incentives, in our view, sort of overcome the disincentives to new development today, and put new development on an even plane with buying existing assets. So we hope that there will be a refreshing of that legislation. We think it's good tax policy. We think it's good urban planning policy, and you can in many cases the developments are very transformative of communities, neighborhoods, and localities in a really positive way. Please.
Thank you for sharing the insights. And I have a question regarding the extend and pretend. If there is one of the mentioned in Trapwire podcast that 25% of the commercial loans are on watch list of delinquency. So if there is going to be the upcoming maturity wall in end of 2025 or early 26, if this is going to happen, if there are delinquencies, how do you see a special servicing industry heading, and what type of asset classes will present opportunity for buyers?
It's a great question. There is definitely a lot of maturities that are coming due. I think that when you think about the underlying assets that have been financed, what is easiest to refinance? Easiest to refinance probably are residential rental and logistics and industrial assets. You may have to take a haircut. There may be a reduced equity component for that refinance. In our view, the real problem child is the office sector. There's very little appetite to refinance office loans, and notwithstanding some initiatives in some cities for transformation of office assets to residential assets or self-storage assets or whatever, that's a long and arduous and tough process that works for some assets but does not work for many assets. So I think you're going to see, I mentioned before, I think we've seen the tip of the iceberg. You remember, icebergs have 10% above water and 90% underwater. The tip of the iceberg as it relates to actual distress in the office sector. For people with a strong heart and a keen eye, buying office assets today or next year, could provide some opportunity. We actually, as a company, we have a separately managed account with an institutional investor who is doing just that. But you have to have a long-term horizon, and you have to have I think a very strong stomach to be able to manage through those opportunities. What's really interesting, and I believe there are some bank investors, bank lenders who are part of this conference. A number of banks now have an REO portfolio, and sort of by definition, that REO portfolio is unlevered. The equities disappeared, the assets are owned because of the previous lending activities of the banks, and those REO portfolios we think have the advantage of not really having a gun to your head in terms of maturities. That's already come and gone. And so we think that there's some meaningful value there as well. Yes.
Does your firm have a geographic focus? A lot of investors have piled into the smile markets, or are you taking more of a contrarian perspective?
That's a good question. We do business in 36 different states, so I guess the answer has to be that we're pretty nationwide. There's a concentration of our activities in what we call the crooked smile states, because the crooked smile extends up to areas in outside of Seattle and Portland and Sacramento and elsewhere. But generally speaking, we like to invest where markets are growing, where households are being formed, where people are migrating to, where companies are relocating to, where the cost of living is attractive, tax policy matters. Generally speaking, people are moving from, and companies moving from west to east, broadly defined, and north to south, broadly defined. Having said that, we invested meaningfully at the beginning of this year in Boston, and that's been a great series of investments as well. Sherry, how much?
Thank you, Bob. Oh, okay. Thank you, Bob.
Oh, no, I think Sherry has. Don't get the hook out quite yet.
Really appreciate your overarching kind of concerns, and as a continuation of our wonderful conversation last night, I do appreciate your commitment to addressing the affordable housing demand in this country today, and how Bridge is really filling the gap between the very expanding gap between supply and demand. I guess my question to you would be a question that a lot of young people and people who are trying to enter the housing markets today, and there's been allegations that institutional ownership of SFRs basically are impacting entry-level home ownership. How do you address that in your strategy?
It's a really good question. And, you know, as a resident and tenant focused firm, we are acutely conscious of how our residents and tenants fare in terms of what they do. I think there's very little reliable data that would show at a 2% penetration rate that institutional ownership of single-family homes has meaningfully impacted price. What we think has been meaningfully impacted is the quality of life of the resident. You know, we pride ourselves and many others in the industry do as well. In terms of the tenant experience, in terms of implementing, you know, programs and policies that make renting from us a preferred way to organize your housing resources, and we think that positive tenant experience candidly far overshadows any price impact, which nobody has really demonstrated. I'd love to see data that would show the opposite, that institutional ownership has made a meaningful impact on price. What has made a meaningful impact on the price of single-family homes is the fact that their supply is so low. People with existing homes aren't selling because they have low mortgages. The ability to build new homes is constrained in some respects by economics, and so that's resulted in an environment where the cost of owning even a starter home is far in excess of the cost of renting a home, which sort of brings into question, not to get too philosophical about it, you know, the validity of the American dream of owning your own home. If you look back 10 years, 20 years, 30 years, if you took the same money that you would have put in a home and invested it in the stock market, you'd be far ahead of in terms of personal wealth where you would be if you owned your own home. And so I think that recalibration is taking place as well. There are just a lot of people who prefer to rent, and if we can provide them, we and others can provide them with a positive rental experience, that's good for them, good for us. Thank you. Thanks, Steve.
Because our next speaker is really, well, what's fascinating